To me was a little different than the babble that she's been giving lately, which I have really thought has been quite incompetent, and just amazing how she has been just ignoring what's been going on around the world. I've been basically giving, I hate to say rants on here, but basically going on and on about how the Fed is really in policy error and making huge mistakes. And yesterday was the first time in a long time that I can now say that they are on top of things. At least Yellen is. This was like vintage Yellen. She was basically taking back, I mean, she basically reiterated the Fed statement that she gave at the press conference after the rate decision. She took back basically all of the statements that the other Fed governors have said about the rate hike still being on the table. I'm going to go through some of my notes here, just as I tick them off. She talks about oil being transitory, although the decline was more than they had expected. That is stating the obvious. She also talked about the dollar effect being transitory. I guess they're going to do what they can now to combat the strong dollar. That has been a big problem with regard to earnings. She talked about this gradual increase in the coming years, the forecast. She acknowledged a mixed economy reading. This is the one point I thought she was a little weak on. She talks about the overall jobs numbers being good, but I guess she doesn't want to say that, we haven't been able to do anything in that regard since it's part of their mandate. But we know that the quality of jobs, the wage growth, and the percentage of the population that are working is very weak, low, and really stall speed here. So the jobs numbers we know aren't that good. She talked about slow global growth, which is very important. I'm glad that they kind of finally got into that. She of course cited the strong dollar for that. The low investment in business. She talked about low capital spending, business investments, and low in production. Yeah, we don't do very much in terms of production in this country. I mean, we do have autos and aero, but besides that, we don't do much in terms of producing things other than, entitled millennials. So that's the story there. She talked about realizing that low interest rates were supporting the economy. Obviously, that's got a huge effect in terms of housing and autos. There's a lot of talk about how great the auto numbers are, but if the interest rates start going higher, that is going to decimate that industry. So that is the truth. Same thing goes for housing. It would be a big problem it would be a really big problem if there were interest rate hikes for the near future in terms of housing. She talked about the pace of rate hikes. She reiterated that they were reducing the expected amount of rates they were going to do. They had talked about doing maybe 2 this year, but the problem, and I think the reason we had the decline a little bit the last few days before yesterday, was yes, we had gotten into some resistance points and there were some pullbacks, but I've discussed this CME website where you can see the probability of rate hikes into the future. And after the Fed decision, there were no months with a probability of a rate hike over 50% until September. It had been pushed out. After the Fed governor started speaking, I think people kind of blew off Lockhart, but once Bullard and company started blabbing, they brought it back. And that's the reason why that started to be undone. After Yellen, and this is the reason, everyone's like, oh, are we going to, go back, take back all of this Fed move, this BS Fed. It's not a BS Fed move. This is actually real, what happened. They pushed the expectations of rate hikes out still further. It went back to September. And it's now not in June and July like it had been before. Actually, today, with today's gap, it's now not showing above 50% in terms of a probability of a rate hike until December. So that is now factoring in 1 rate hike for the rest of the year. That might just be their December, rate hike like they did in 2015. So maybe it's just like a December type of a situation. And I don't even know if they're going to go there. So that is a new development today. Yesterday it had been pushed to September. Now September is only at 42%. November is at 46%. And December is at 59%. So the market doesn't anticipate a rate hike until December. That's why today was able to kind of hold the move. So let's get back into these notes here. This is very important, but that is why the market rallied. I don't want to hear what anyone else has to say. That is the reason. It was the expectation of interest rate hikes going forward has now been pushed further out and reduced. That is very key, and that is what the market is rallying on. I'm just looking here. Where was I? She reiterates that this is only a forecast and that they're willing to, kind of adjust in there. This, to me, again, was striking. This seems to keep missing the press, but she talked about not seeing 2% inflation in 2016. If that's true, I don't know why they're hiking rates at all, frankly, December or otherwise. If they aren't able to reach that, there's no reason to be hiking rates considering growth is below there. So you really almost have you really have deflation still. If you're growing at 1.4% and your inflation rate is supposed to be 2%, you tell me. That's not good. In real terms, yeah, you have a little bit of a growth, but in the true sense, you're negative. She doesn't see that returning until 2006, 17, or 18 to get back to 2%, but of course it's transitory and they'll get there. I mean, they've been wrong for 7 years, but now magically they'll be right. She talks about the Chinese exchange rate policy. I think what Janet Yellen and the Fed don't understand, and I think this is just because they're a bunch of nice people and they're very politically correct, and the whole world, I think, is in on the joke except for the Fed, that there is a currency war going on. Everyone in the world knows except for us. We're like the last man at the deal, the 11th man on a 10-man deal team or something here. It's a really big problem, and I don't think it's good that the Fed acknowledged the problem now. You can't get to a solution for a problem until you define it, but they still don't understand why. It's clear what the Chinese are doing. I mean, they are they're burning their currency to be able to sell their goods cheaper, and the Fed, the dummies that they were in December, helped them by raising interest rates. They firmed up the dollar. If anything, they should be weakening the dollar. Yes, exactly, manipulation. The Chinese are like the #1 manipulators. They should have a gold medal category in the Olympics for currency manipulation. The Chinese would be like stapled to that podium. So, yeah, the Fed needs to get off their PC high horse there. So here she talks about stability in longer run inflation expectations. That's their baseline. She said it could take longer than expected. That just means lower for longer. That's code for lower for longer. They talk about this baseline rate. And if they don't feel that that's stabilized, that means there should be no interest rate hikes. They talk about this blue chip survey that they're using for some of these economic numbers. This to me was quite stunning. Remember when I said I had 6 Fed keys and now it's 7 officially because they acknowledged they're looking at the market? They, in a stunning level of candor, said that down moves have been muted because of the public's expectation of Fed intervention. Holy shit. Oops, sorry. But that is absolutely stunning for the Fed to admit that they're really watching the market and they're testing it. So I believe they're acknowledging here that they, a lot of this double talk and this, backspeak is to test how the market can handle these moves. Maybe this is a coordinated effort with these Fed heads with all the stuff they say to kind of see how, where the market can go. Seems very obvious to me. It seemed very obvious to me the whole time, but they are now admitting it. It's sort of the kimono is being parted. Let's see, where did we leave off here? The gradual evolution of gradualism. This, to me, was amazing. This is almost like a haiku when you talk about some of these things that the Fed talks about. So the gradual evolution of gradualism, they were talking about, can't read my writing here. They were talking about the cyclical nature of, the economy and the jobs and stuff. I've gone over this. that I think that we have structural problems. I've talked about automation and AI, the rise of AI, and the problems I think that that will cause in the future. I do not want to reiterate that conversation, but it's real and it's happening and it's not going away. It's only going to get worse. So the Fed, I think they did mention this with regard to technology, which was great. That's really what I wanted to hear from them. I've heard Janet Yellen, I think over the summer, I forget, I was in a car ride and I was listening and she had mentioned this, and now this is the second time she's mentioned this. So that was very important that Janet Yellen is recognizing that. She talked about involuntary part-time workers. So that is good that she's realizing that was sort of, I guess, later on here. She kind of backtracked on her statement that the jobs numbers were good. Involuntary part-time is partially because of the Obamacare tax. Companies are hiring people part-time or offshoring to avoid paying the healthcare tax. It's a really big deterrent for businesses. So she didn't quite take that leap further, but if she could, that would be quite stunning. She talked about the neutral Fed funds rate, and they're uncertain of the correct level. That got me a little bit concerned, because the all-knowing, omnipotent Fed should know this. The truth of the matter, if this was a real world here, they would float the rate already. Let the market determine the rate. Stop this artificial manipulation. It's not doing very much other than, having a lot of unintended consequences here. Although, according to the Fed here, they, the only reason for any of their growth here is now because of the low interest rates. So that's there to stay. And if they don't know what the correct level is, my guess is they're going to be going by the Hippocratic method. The first thing is to do no harm. So that means no more rate hikes. Very dovish speech. I'll tell you, this is, in all candor, this was the most engaged and sharpest I've heard Yellen in a long time. I guess she slept well this time. There was none of those sickly pauses like she had a couple of press conferences ago. This was one of her best, and I think it was majorly dovish. We'll talk about today's action in a little while. Someone was asking me about what do I think about today's lackluster action. We'll get there. We'll get there in a little bit. Where was I here? And then this to me was unbelievable. Yeah, I mentioned the productivity growth and I mentioned the technology. They hinted at QE. I'm sorry, they didn't hint at it. They basically explicitly said that they would do QE. If things got badly again, they would use their tools to suppress interest rates. How do they do that? They do open market operations, and that is been dubbed QE. QE has been around for quite some time. It's just the tools in which the Fed uses to manipulate interest rates, and they were talking about open market operations to suppress interest rates. That's more QE. So that's on the table now. So we now have to start talking about the potential for QE4, not necessarily rate hikes. Yeah, I agree. I'm just reading what some of you guys wrote in the chat here. Do they have? Yeah, the tool. Yeah, I mean these tools would work. It's worked before. I don't know why it wouldn't work again. A lot of countries have taken interest rates negative. It wouldn't surprise me, believe it or not, if they were to do that here. I don't know how well that would go over in the election cycle. I think it would be a huge point of contention, but it could happen. So that covers the Fed. So my critique on the Fed, like I said, was this was a phenomenal speech. Janet Yellen nailed it. She really covered, this was pretty much almost everything I could hope for in a Fed speech. And I think she assuaged the markets. It happened in a really timely fashion, considering I had talked about in the weekend video having the shake and bake, meaning we had a little bit of a sell-off and then they bake it to the upside into quarter end. You have quarter end, a dovish Fed. What's not to like? Buy them. So they did. They bought them. So where are we now? Let's get into the market and where we are level-wise, because that's really here what is going to matter. It's what always matters. It's really only whatever matters. So if you take a look at yesterday's range, that's the new bogey to trade against. And we basically closed right at the top of a consolidation range, and today's gap, believe it or not, did not surprise me. Someone was asking why we had a lackluster day. All right, so let's address that off the bat. I'm curious to see, this is a terrible question to ask because you won't be able to see this on YouTube, but you could see it in the chat room here. I'm just curious to see how many people thought today was bullish or bearish. I'd be curious to just get people's take on that, to see where people's heads are with that. So maybe I'll do a, yeah, bullish, bearish, see bullish, bearish, bearish, everyone bullish, bullish. So it's, I'm just looking. So it seems like an even mix, maybe a little bit, a few more bulls. All right, so let's discuss that. My take on today's price action is that it was in fact bullish. Why was it bullish? Because you had breakaway value to the upside. The only couple of kind of pieces of loose change that we have here was, yes, today was a bit of a doji. We didn't go very much. But I think today was really just more of a digestion of yesterday's move. I think part of the selling today, at least early, was simply that we were up really big. It's Wednesday, and it's into the quarter end. And I think people just saw the big move up yesterday, the gap today, and they were like, let me, kind of book some of this, at least some of it. You kind of have to. We also touched a level that I had discussed yesterday, and I said that if we had gotten through the 205.23, that I thought we would see 206.76. We got it. I think we got 2 ticks above it. We actually got a little bit more, even more above that. We got 206.87. So between, like I had been saying in the weekend review video, 206.76 and 207, that is getting into the meat of the overhead supply, the distribution. It's really thick. The dead bodies of people who were wrong are up there. So I think there's also a little bit of responsive selling up there. I will say this, though. Given and I'll just say this. It wouldn't surprise me if we have a few days sell-off, even maybe get back into the Fed range a little bit. I still think, based on what Yellen said, that the market is likely to go higher. I know that it sounds nuts, but it's actually very likely here. If the Fed isn't going to raise rates, and they're factoring in 1 hike now, we had been told initially 4 and then 2, and now they're only pricing in 1. The market deserves, with low interest rates, historically low interest rates, to trade at historically high PE multiples. If you're, topping in a market at a 15 to 17 PE and interest rates are 5 to 7%, what happens when interest rates are, 1 to 2%, 3%? These, we're not even there. I mean, their end range target for like 2018 is 3.5%, for crying out loud. So, that's what, to me, you have a company, I hate to pick on this one, but it's been up a lot. You've got Coke trading at 27 times earnings. They make soda. They make sugar water. But they have a 3% dividend, so it's being chased up. And the stock is basically nearing all-time highs. By the way, getting close to some channel resistance, a little bit higher, so I'd be a little careful if you were first chasing into Coke. However, if you do a 1.618 Fibonacci extension on it, it could reach $50. Is it so crazy to think Coke could go from 46 to 50? Very, very possible. These things aren't, like, on an absolute basis completely out of the question. It's not exactly a grower. I mean, you got Google, for example, trading only at 33 times earnings. And that's current earnings, not forward earnings. They have growth. So to me, there was a question on TV yesterday, which is the bargain, and my answer, I would think Google is more of a bargain in that instance. Anyway, getting back to SPY. So there are some important levels here to pay attention to. One is today's high of day and today's low of day. If we were to have a break of today's low of day tomorrow, particularly on a gap, I think a lot of people are going to say it's an island reversal, and they're probably going to be looking to book some profits, and you'll probably get into the Fed range a bit, maybe back down to like the 204 level. I think I had mentioned on the stream today that I saw in ES, I think it was 2033 to 2041 half. Let me just flip back. let's not wing it. Let's just give the real levels. Yeah. The 2033 was yesterday's VWAP, and an important breakout level really was the 2041 half. So I would look to that, and today's value area high was 2042. Doesn't surprise me that it was right around there. So I would think in that area there should be some important support. You may want to tag out some VPOCs. You had 2017, I believe, from yesterday. I don't have that on my screen, but that's what my memory has me, in 2025. So around there is really where the Fed, I guess, the Fed spike took place. So that would be kind of your first target if you're looking for short. But I'm really thinking, I'm really starting to think after hearing Yellen yesterday that we might be back in a buy the dips market, and we could be making a move to close to 109. That would be the primary downtrend, roughly up there around 109. There's also an old reference high around 208.97. But given the fact that we gapped into the 206.76 and we gapped into the meat of the beginning meat of a volume distribution, it doesn't surprise me that there was some selling and some consolidation today. That's very normal. It was actually a little bit expected. This did not surprise me in the least bit. I actually thought if we would have had a gap today, that this was exactly what would have happened. We would have had some digestion. But if it's hard for me to see people say that that today's price action was bearish, because we're above the Fed day range. Yesterday I will say yesterday is a Fed day. If you're above the 205 quarter, which is the Fed day high, you're kind of forced to be long. If you start getting back into that range, I'm fine with being flat to neutral, or if you want to try short against that as a stop. But as long as we're above that high and with breakaway value like we had today, you can't really say today was bearish in my view. Whether or not that'll turn into bearishness tomorrow is another story. But with regard to today, it's hard to make that. It's hard to make that that argument, because the price action to me, is clearly higher. You're above that level. A lot of things acted toppy. Yeah, but it's the end of the quarter. You have to keep that in mind. There was some degree of lock-in. They moved tremendously yesterday. I realize probably a lot of people bought late and were chasing, and this is why I always say trade location is important. And I think those people may have been a little frustrated today, but things may have acted may not have just kept on running in a straight line today. But keep in mind where they were coming from. They were up huge yesterday. So a little bit of consolidation. If things were just flat today, that would have been fine. Even if they were a little bit down, that would have been fine. So here's my thinking. We have another 2 days for the quarter to end, and then next week we start the new quarter. We are going to know a lot next week if this was real or not in terms of the price action. I believe that the Fed language is a bit of a game changer. I talked about making a bold call on here. I believe we could possibly retest the old all-time highs and maybe even make new highs now. If they are going to factor in 1 to 0 interest rate hikes for this year, the market can go higher. That is just how it is. If they start factoring in more, then we're going to have a pullback, and I'm going to keep a very keen eye on that study. That is very, very important. So that is my thinking. As of right now, I think that it is very possible for them to potentially retest or make a new all-time high. It would not be out of the question. We are only a few points off of the all-time high now. We've had a couple of very large pullbacks. It's very possible. Let's see how we act next week. If next week, we finish strong this week and then next week is just a complete sell-off, then I would say that we're into a summer sell-off and it was just end-of-quarter window dressing. The truth is we will not really know until next week. But I will say this. I believe Yellen's discussions were a game changer. You have a 50-day moving average that is arcing up, the 200, which is flattening out, and a 20, which is really just under the lows of yesterday's Fed day low. So the market isn't really overbought here, believe it or not. As with yesterday being up big, and even today, we're not really that terribly overbought short term in relation to the 20-day moving average. You had 1, 2, 3, 4, 5, 6, 7, and part of yesterday, 8 days of consolidation in a range. That is definitely working off a little bit of overbought conditions short term. yes, the bigger picture, the market is overbought a little bit stochastically. In a measured move, it is overbought. If you want to try, like I said, if you want to try short against today's high, go ahead, but have a stop there. It was a narrow range. There's no shame in testing it. I would be more apt onto like another couple of days push. Like if we were to gun it tomorrow and Friday, or at least big tomorrow and like kind of just be like a little flat Friday, then maybe I might try it. S&P is getting into some key reference areas that it's not just going to blow through here. You have a VIX down at the lows. I talked about today with regard to VIX that 1280, I believe, takes back the entire move of the last leg. And we basically formed a little bit of a doji, of a hammer there, and it's way oversold. So I don't really see, the point in playing for lower VIX here. Yeah, you could get a little bit of a press lower, but when VIX is low, I'm an interested buyer in maybe S&P puts is at the very least a hedge against longs. So that's my thinking there. Crude oil. There's a lot of talk. Are we coupled? Are we decoupled? The answer is it's still very relevant. The oil names really need to kind of lead. We're coming into, I think, a more seasonally strong period for driving, so gasoline should get a little bit of a bid. There was a gap in the futures. We basically stalled a little bit under the 200 MA. We're basically sitting here on the 20. You have a 50, a few points below her. Oil came off of 26 and got over 40. Is it possible it pulls back? Yes. I do believe, though, that the worst for oil is famous last words. The worst of it is probably over, and I'm looking to kind of reload and buy the dips. I talked about Exxon. That is the key for me. As long as Exxon is over $83, and I don't want to get into why that number is what it is, but it is what it is. So as long as Exxon is over 83, I think you can construe oil pullbacks as buyable. If we were to lose 83, then we're talking about 80 and 78s in play, and things could get a little bit more squeamish there to begin with. If oil confirms and holds the 83s and then takes 86, 87, we're off to the races, and we're probably on our way to 50, 50 or maybe even higher. So just keep that Exxon number in play. That I believe that is the correct way to look at oil. So we had this gap. It wasn't a real gap. It was just a futures roll gap. So it just kind of took that back and spent a few days here consolidating. So oil's really done not that much. It's really just been consolidating. It looks like it's been selling off, and I guess it has in real terms, but it's just taking off the roll. The roll from when we went from one contract to the next. What do we want to talk about? Gold has been rallying. That's just a weak, a play on the dollar. It's up a real lot. I would be a little careful chasing. If you want to play it for pullbacks, I'll tell you this. We rallied from basically 123. I'm doing this analysis, believe it or not, in real time here, live. Gold really loves technicals. We broke a downtrend. There's a 50 MA below. I would say the 50 MA is a key level. But gold, for some reason, likes Fibonacci levels, and it loves 61/8. If you were to get down to like 108s in gold, or even if there's a little bit of an overshoot, I'd be interested in kind of nibbling there or selling some out-of-the-money puts. That's just my take on that, at least for a short-term bounce at the very, very least. Silver is the same kind of thing. It hasn't been really rallying as much, but it's been holding in there. It even, believe it or not, when gold was making fresh lows, silver was just kind of being a honey badger and stubborn. It has some industrial use in there, but it's kind of just consolidating here sideways. You got a 50-day moving average right below. If you want to play long, why not play against that 50, 200-day moving average? It's all in the 14s. I like 14s. If SLV can hold 14s, I think it can go higher. If it gets below, it gets a little bit iffy, less clear, I should say, less certain to me. With regard to Apple, I talked about this acting strong, and I had said a couple of weeks ago in my weekend review video that this was the most bullish I had been in Apple in a long time. It had been acting quite well, and today it did quite well. However, we're getting close to some resistance here. 109 to 111 is an important band. The 200 MA is 111.58. It's also the peak of a kind of an interim volume distribution. It's also the primary downtrend line. Apple is also, if nothing, a pinning fiend. It loves to pin into options expirations. And we are going to have the end of the quarter plus this week's options expiration. I'm trying to pull this up quickly here. Volume, open interest. There is a lot of OI in the 105 puts, but anywhere between 108 is really where the call volume, 110 to 108 is really where, this is going to be tough to game here right now because there was a lot of volume today that actually even eclipsed the open interest. So I'll post tomorrow morning where the OI settles once it rebalances for tomorrow, but it's not going to really make that much of a difference even tomorrow. It's really going to matter for Friday since we have 2 more days. But 110 to me, it wouldn't surprise me if that is a little bit of trouble for Apple with regard to the pin, just because it's a nice big number. People were asking about, I'm just going through the list of some of the other stocks that people were asking about. Tesla, there was a big short squeeze. It broke the downtrend line. It looked below and failed, and now it's kind of just chopping around here. These 225, 226s area is really important. If it can hold there, we could see 265s. If it loses there, then we're looking maybe into the lower 200s. I would be more of an interesting buyer somewhere between like 191 to 195 area. That's like, well, where are we? The 50 MA is roughly 193s. The 61.8 is 178. I don't know if we're going to get that low, but there's like I said, the volume distribution there is around the 201, 202 level. I like playing put ratios for a move down to there if there's weakness in Tesla. So I think if the more it consolidates here, the better it is, roughly around the 200. If it starts losing the last, like, let's say 3-day lows, then I'd get a little bit iffy. As of now, that big down day could be construed as a secure low, the 215. I don't see this as being a short here. I just see it as being a bit of a consolidation, and it could actually press a little higher. It just moved a lot really fast. That's my take on it. Some people were asking me about this Valiant. I know everyone wants to kind of buy and catch the bottom, and that the stock was once, $263 and now it's 20-something or whatever. The stock could really honestly be a zero at one point. I hate to tell you that, but the debt is worth more than the equity here, and there's something called debtor in possession, known as DIP financing, where they could cancel the common and the debtors get the company. That is real. That could happen. I would be very, very careful. That being said, it's being cleared off books into the end of the quarter. If you want to buy this, I would wait until the end of the quarter and give it a try next week. Or if you want to buy it late on Friday, that to me is the way to play it. I mean, I don't know any PMs, portfolio managers who are going to want to show clients that it's on there. I don't know if I would be shorted here just because it's been down so much, but I mean, if you get below 25.99, you could try short. You have a narrowed consolidation range here. If you were to take that short, you'd probably want to cover anywhere above, unfortunately it's a little higher, 35.82, but you could try a right out and give it, a couple of points. I would say anything below those mid to low 30s is still pretty bearish to me. Facebook, I wanted to talk a little bit about. So we're getting close to the progression line. We got the 116s, which I had talked about being a little bit of resistance, a good trim and trail spot. We looked above there a little bit, and we came back. The FANG stocks, I think in general, were a little weak today. Let's take a look. Apple was the honey badger, a little strong. Amazon was fairly strong. I think Netflix, Facebook was weak. Google was kind of and same thing for the Netflix. Netflix had been strong the last couple of days, but today pulled back. So there was a little bit of selling. I think that was a little bit of lock-in from people who had been long. Netflix came back quite a bit today. It couldn't hold Today it had a bit of an early move. It got into the resistance, which I had been talking about. We just stopped short of 105, but 103.88 to 105 is really the resistance band. And it does not surprise. It was also the end of the volume distribution. It still is holding trend here. So if you want to play, long, I would use this could pin 100. I really am going to have to look at this a little later in the week. It wouldn't surprise me. But we got into some resistance. I would be, and you got a lot above you. You got a 50% fib. You have a 200 MA, 100 MA. You probably want to start lightening up a little bit on some pops. I do think that there could be some more up move, but I'm a little iffy. This is really kind of the area that needed to hold. It broke down, and now we're kind of testing back. So I'd be a little careful with the Netflix pattern. It had a kicker pattern the last 2 days. I talked about that 3 days ago, that I thought it was looking more bullish. It wound up being more bullish. I'd be real careful. If you start losing, let's say tomorrow will be another day, the 3-day low, so below 101, I would be really cautious with that stock. I think we covered quite a bit here. Yeah, I think we could, maybe we'll wrap there. But let's keep an eye on, with regard to SPY, I really want to reiterate this. A lot of the moves in these stocks now are going to have to do with the overall market. And if the market starts rallying, a lot of these stocks are going to get pulled up with it. And if we start selling off a little bit, we're going to then be back into the looking at the 204.12s. That to me is the key level. Any closes below there, and I'll start thinking that that the market isn't acting right. If you start making any closes, I've said this before, anything below 204.12 has always led to pretty much a nasty gap down. This past week was no exception. I did discuss in the weekend video, though, that this time might be different, and to me it was looking different because we gapped to the 201.90. The last times we went through there, this time it held and it was a 200 MA. You don't just gap to a 200 MA, on a Friday and just dump. So it's if the market is healthy. So it seemed like that the tone. It seems to me like the tone here is changing a little bit, and a lot of that is because of the Fed. And as long as the Fed, I hate to be a broken record here, but as long as the Fed is accommodative and going to be on the sidelines, that gives that makes stocks again the only game in town. You're not really getting much in terms of interest rates with Treasuries. Today was a little bit of a funny day. Speaking of Treasuries, you had a bit of a hammer today. You were down earlier. It basically has a 20 and 50-day moving average confluence below it. I think you could use today's range as important. If anything below today's low, I think could get a little bit slippery, maybe back down to the 127s. Above, keeps the dream alive of higher bonds. Anyhow, that's going to be my story. I'm sticking to it. I will show you a lot more of this stuff in the, including what I was seeing in Restoration Hardware. I'll talk about that trade a little in the weekend review. I think that would be kind of instructive as to what to look for. That could be a little bit of a mini trade school, right? Anyway, if you want to see this, it'll be on my YouTube channel in a few minutes. I'm going to upload it now. I hope this video was helpful, particularly the Fed analysis. If you could really nail the Fed, you really can nail everything. Have a good rest of your week, and just be a little bit cautious. I do believe short term, you want to be more of a buy the dipper and a sell the ripper. Cheers.